You never filed the freeze?
Nobody told me it existed.
If you're 65 or older, there's a good chance you're paying a bill in full right now that the law never said you had to pay in full. Robert didn't know that. He's 67, retired 2 years ago, owns his home outright in a suburb outside Houston. Careful man. Paid every bill the day it arrived, never late on anything in his life. Last fall, his property tax statement came in the mail, and he did what he'd always done. He wrote the check, the full amount. What Robert didn't know is that the year he turned 65, Texas locked the school tax portion of his bill at the exact dollar amount he owed that year. Locked it. It's not supposed to rise again, no matter what his home is worth. But that lock isn't automatic. Nobody at the county calls to tell you. You have to file for it. And because Robert never filed, the county kept billing him as if he were 45, and he kept paying it because the envelope said that's what he owed. That's one bill. There are 5 like it, 5 bills that change the day you cross 65. Some you can shrink, some you can push back, one you can walk around entirely. And every one of them works the same quiet way. The relief is real. It's written into law, and it will sit there unclaimed for the rest of your life unless you go and take it. Before we go further, I'm not a lawyer, I'm not a CPA, and this isn't personal financial advice. It's the briefing that helps you walk into the right office already knowing what to ask. Do me one favor as we go. When you hit the one on this list you didn't know about, drop it in the comments. So other people scrolling past this know to check theirs too. We're counting these down from the smallest to the one that costs the most if you get it wrong. And the last one isn't a bill you overpay once. It's a mistake that adds a little more to every payment you make for the rest of your life. Bill number 5, jury duty. We'll start with the smallest one because it cost you a day, not a dollar. And because almost nobody knows it's optional. Jury duty. For most of your working life, that summons in the mail was an order. You rearranged your week, you showed up, you sat in a room. And for decades, that was simply the deal. But somewhere along the way, and this is true in most states now, the rules quietly carved out an exit for older residents and never bothered to mention it on the summons itself. In Mississippi and South Carolina, once you hit 65, you can be excused from jury service full stop. In roughly 20 states, the line is 70, places like Texas, Florida, Georgia, California, Illinois, Michigan. Cross that age, and you can ask to be permanently excused. Other states set it higher, 72, 75, even 80 in a couple of them. The exact number depends entirely on where you live, which is the theme of this whole video, so keep that in mind as we go. That exemption is almost never automatic, and that's what catches people. That exemption is almost never automatic. The summons still arrives. It still looks like an order. And if you just show up the way you always have, you've effectively waived the exemption without knowing it existed. To actually use it, you check a box on the form, or you send a short written request to the court clerk. That's it. One box, one letter. And it's not just the state courts. Federal courts don't hand you an automatic pass at any age, but they'll generally excuse someone 70 or older who asks. Same principle. The door is there, but you have to be the one to open it. Now this one won't save your retirement. I'm putting it first precisely because it's the easiest to act on, a 2-minute task that shows you how every one of these works. The relief exists, it's written down, and it waits for you to claim it. So tell me in the comments, what age does your state let you off the hook? People genuinely don't know, and the answers are all over the map. Your neighbor 2 states over might be living under a completely different rule. That's the small one. The next one is bigger, and it depends on a single decision a lot of retirees make without realizing it's a tax decision at all, where they live. Bill number 4, state tax on Social Security. The 4th bill is one you might be paying for no reason other than your zip code. Social Security. You paid into it your whole working life, out of every paycheck, for 40 years. And most people assume that when it finally comes back to you in retirement, it comes back taxed the same way everywhere. It doesn't. Whether your state reaches into that check depends entirely on which state you retired in. And the map is lopsided in your favor. 41 states don't tax Social Security benefits at all. Not a dollar. If you're in Florida, Texas, Pennsylvania, or most of the country, your state already leaves that money alone. But a small group of states, 9 of them, still tax those benefits in some form. States like Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, and West Virginia. Now I want to be careful here, because this list has been moving. Several states have been phasing this tax out over the last few years, and the exact roster changes almost session to session as legislatures repeal it. So if you live in one of those states, don't take a number off a video as gospel. Check your state's current rule, because it may have changed in your favor since this was filmed. That's not me covering myself. It's genuinely a moving target, and it's moving in the direction of leaving retirees alone. And even inside the states that do tax it, most don't tax it the way you'd fear. Many exempt lower and middle incomes entirely, or follow the federal formula so only a portion is ever touched. The blanket. My state taxes my Social Security panic is almost always worse than the reality once you read the fine print. But here's why this matters beyond the 9 states. If you're deciding where to spend your retirement, where to move to be near the grandkids, where to stretch a fixed income furthest, this belongs on the list next to the weather and the cost of a house. 2 retirees with the exact same benefit can end up with different net checks purely because one crossed a state line. So let me ask directly, because I'm curious how this splits. Does your state tax your Social Security? Drop your state in the comments. I'd bet most of you are in the 41 and don't even realize you dodged it. That covers what your state takes. But there's a second layer sitting underneath it. The federal government's cut. And that one runs on a rule that hasn't been touched since 1983. Bill number 3. Federal tax on Social Security. Here's a number that should bother you more than it does. The income limits that decide whether the federal government taxes your Social Security were set in 1983. They have never once been adjusted for inflation, not in 1990, not in 2010, not this year. The same dollar figures written down when a gallon of gas cost 90 cents are the figures still being used on your return today. Let me show you how they work, because this is where most retirees quietly get caught. The IRS looks at what it calls your combined income, roughly your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefit. Then it runs that number against 2 thresholds. If you're single and that combined income is under $25,000, your benefits aren't taxed at all. Between $25,000 and $34,000, up to half of your benefit becomes taxable. Above $34,000, up to 85% of it can be taxed. For a married couple filing jointly, the lines sit at $32,000 and $44,000. Same structure, same jump to 85% at the top. Now sit with what the frozen part actually means. In 1983, those thresholds were high enough that almost no retiree crossed them. This tax was designed to hit only the wealthiest recipients. 40 years of inflation later, a modest pension and a normal Social Security check will push an ordinary retiree straight past both lines. A tax written for the rich now lands on the middle. Nobody voted to expand it. It expanded on its own simply by standing still while the dollar shrank around it. There's one trap inside this worth naming out loud because it's brutal and almost nobody sees it coming. If you're married but file separately and you lived with your spouse at any point during the year, your threshold isn't $25,000 or $32,000. It's 0. Up to 85% of your benefit is taxable from the very first dollar. Couples who split their filing for some other reason, a medical deduction, a student loan calculation, can walk into this without ever realizing they flipped a switch. But there is a door out, and it's brand new, which is exactly why most people don't know it's there yet. Starting with the 2025 tax year, there's an additional deduction for seniors, around $6,000, that lowers the income the IRS counts. For someone hovering just above one of those thresholds, a deduction that size can pull your combined income back under the line and shrink or even erase the tax on your benefits. It phases out at higher incomes, above $75,000 for a single filer, $150,000 for a couple. And as it's written today, it runs through 2028. So if you're anywhere near one of these thresholds, this is the year to run the actual math, not assume last year's answer still holds. If any of this is landing a little too close to home, that's exactly why it's worth sending to the people you know who are about to file. A son or daughter helping a parent with taxes, a friend who just started collecting. This is the kind of thing that costs a household hundreds because no one at the table knew to look. And speaking of the roof over that table, the next bill is the one with the biggest dollars on the line, and it's the one Robert got wrong at the very start of this video. Bill number 2, property tax. This is the one with the most money on the line, and it's the most frustrating because the relief is enormous, and it's buried behind a form almost nobody is told to file. Property tax is different from everything else on this list. There's no single national rule. It's set county by county, state by state, and the programs that protect older homeowners are a patchwork, which is exactly why so much of this money goes unclaimed. You can't stumble into it. You have to know your own state's version by name and go ask for it. Let me walk you through 3, because they show you the range of what's out there, and then I'll tell you how to find yours. Start with Texas, because that's Robert's state. In Texas, the year you turn 65, the school tax portion of your property bill, which is the largest chunk of it, gets frozen at that year's dollar amount. Your home can double in value over the next decade. The appraisal district can mark it up every single year. That frozen school tax number is not supposed to move. Robert's home has climbed in value since he turned 65, and every year the county billed him the full rising amount, and every year he paid it, because he never filed the form that would have locked it. That's not a rounding error. Over a retirement, a frozen ceiling versus a rising bill is the difference of thousands of dollars paid out of a fixed income for nothing. Now go to New Jersey, which took a different approach and made it unusually generous. New Jersey's newer senior program can deliver a credit worth up to $6,500 a year against your property taxes. And here's what makes it remarkable. The income cap on it is $500,000. That's not a narrow program for the near broke. It's written wide enough that a very large share of the state's older homeowners qualify, including plenty of comfortable ones who assume relief like this was never meant for them. Then there's New York, which does it a third way. For 2026, New York expanded its senior exemption so it can knock as much as 65% off the assessed value of a qualifying home before the tax is even calculated. It's income capped, and your local government has to have adopted it. So it's not universal even within the state. But where it applies, cutting the taxable value of a home by nearly 2/3 is not a discount. It's a different tax bill entirely. 3 states, 3 completely different mechanisms: a freeze, a credit, an exemption. And that's the whole point. Whatever state you're in has some version of this, and it will not look like your neighbor's. The one thing they all share is the part that trips people up. None of it arrives automatically. Nobody mails you the freeze. Nobody applies the exemption on your behalf. You file it with your county assessor's office once, and in most places, it stays in place after that. But you have to make the first move. So here's what I want you to actually do, because this one's worth the phone call. Look up your county assessor or your state's Department of Taxation and search the words senior property tax with your state's name. Then tell me in the comments what your state offers. Because between all of you, we'll end up with a map more useful than anything the county's bothered to publish. And someone reading it is going to save real money. That's 4. The last one is the one I'd circle if you only remember a single thing from this video. Because unlike every bill so far, this isn't a mistake you make once. Get it wrong, and it charges you a little more every month for the rest of your life. Bill number 1. Medicare Part B, late enrollment penalty. This is the one I'd underline if you forget everything else, because it's the only bill on this list that doesn't punish you once. It punishes you forever. Medicare. Part B, the part that covers your doctor visits, your outpatient care, has a standard premium in 2026 of $202.90 a month. That's the number everyone pays at the baseline. But there's a rule sitting next to it that catches people who thought they were being smart by waiting. If you don't sign up for Part B when you're first eligible and you don't have a specific kind of coverage that excuses the delay, Medicare adds a penalty. 10% on top of your premium for every full 12-month period you were eligible and didn't enroll. Wait 2 years, that's 20%. Wait 3, 30. And that penalty is permanent. That's what makes it different from a late fee on any other bill. It doesn't fall off after you catch up. It's baked into your premium for as long as you're enrolled in Part B, which, for most people, means the rest of your life. Do that math on a real life. Someone who delayed 3 years is paying 30% more every month on a premium that already climbs most years. Over a 20-year retirement, a one-time decision to wait becomes thousands of dollars, drained slowly, quietly, a little, every month. Now, there's a legitimate reason to delay, and this is where it gets dangerous, because the exception is real but narrow, and people cling to the wrong version of it. If you're 65 and still actively working, and you're covered by your current employer's group health plan, and that employer has 20 or more employees, you're allowed to delay Part B with no penalty. When you finally stop working, you get a special enrollment window, 8 months from the day that employment or coverage ends, to sign up penalty-free. That's the real exit. Working, covered by a large current employer. That's it. The trap that costs people the most is a misread of that word current. COBRA does not count. Retiree health coverage does not count. A plan you bought on the individual market does not count. None of those are current employer coverage in Medicare's eyes. So the person who retires at 65 goes on COBRA for 18 months thinking they're covered and skips Part B. They're not protected. The penalty clock was running the whole time, and they'll carry that surcharge for life without ever understanding why. If you're planning to lean on COBRA or a retiree plan to bridge a gap, that is the single most expensive assumption on this entire list. This is the one to share, plainly. If you know someone at 64 or 65 still deciding what to do about Medicare while they've got other coverage, send them this before they make the call, because this is a door that closes quietly and doesn't reopen. So there they are. 5 bills, and not one of them shrinks on its own. The excused jury summons, the state tax most of you already dodged, the federal threshold frozen since 1983, the property tax form sitting at your county assessor's office, and the Medicare timing mistake that never lets go. Think back to Robert, paying his full Texas property tax bill every year, careful and on time, never knowing the county was billing him for a ceiling. The law said should have been frozen the year he turned 65. He didn't lose that money to a scam or a market crash. He lost it to a form he was never told to fill out. That's the thread through all 5. The relief is real, it's written down, and the system will let you pay full price indefinitely until the day you walk in and claim what was already yours. None of it is a loophole. It's the law working exactly as designed. You just have to be the one who asks. So this week, pick one. Jury duty is the easiest. That property tax form is probably the most valuable. Make the call or run the numbers. And one more time, because it matters. I'm not your lawyer or your accountant, and none of this is personal advice. Rules shift state to state and year to year, so treat it as the briefing that tells you what to go verify. Then confirm the details with your county, your state, or a professional before you file. Tell me in the comments which of these 5 you didn't know about and what state you're in. Someone scrolling past, in your state, is about to learn they've been overpaying too, and your comment might be the thing that catches it. If this saved you even one bill, send it to someone about to turn 65.